Hello, everyone, and welcome to today's webinar. My name is Anu Sood, and I'm the Director of Product Management at Alessa and today's moderator. Today's webinar is on understanding wire transfers and their money laundering and fraud risks. Today's presenter is Laurie Kelly. Laurie has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, she served as Director of Compliance for CoBank ACB, a $145 billion farm credit system institution, where she developed and managed the bank's AML, fraud, and economic sanction compliance programs. She holds CAMS designation as well as CAMS audit specialization. She also helped found the ACAMS Colorado chapter, serving as executive board chair and programs director. And with that, I'd like to hand over the presentation over to Laurie.
Oh, hello, everyone, and thanks so much for joining the webinar today. As Anu mentioned, I spent the last 12 years of my career running the AML, sanctions, and fraud divisions for a very large U.S. agricultural credit bank. Now, our customers' primary way of moving money on and off their accounts was through wire transfers, and we processed about 12,000 to 15,000 wires every day, and about half of those were foreign originated or destined. So I've spent a lot of time working with wire transfers from an AML and a fraud perspective. So my objective today is to give you lots of insights into how the predominant funds transfer systems work and why wire transfers are so prevalent in money laundering and fraud. So we're going to start by just defining what is a wire transfer in comparison to other types of funds movement. And we'll compare wires to the second most popular type, ACH. Next, we'll go into detail on each of the three major wire transfer systems, FedWire, CHIPS, and SWIFT. And we'll discuss the language of wire transfers that's used within each of these systems. And next, I'll talk about what I consider to be FedWire's biggest weaknesses from an AML perspective, and also just talk about some of the myths and misconceptions people often have about wires. And then the final segment will be all about how wires are used in money laundering and fraud, the red flags, and ways to identify and mitigate risk. Now, I do want to mention that there are two topics that relate to wire transfers that we won't be covering in depth today, and those are the FinCEN travel rule and OFAC sanction screening for wire transfers. In February and March this year, we did in-depth webinars on each of these topics. So check out the recordings of these two webinars on Alessa's website if you want to go deeper into either of these. Now, we should have lots of time for Q&A at the end of the presentation, so enter your questions as they come to you, and we'll try to cover them all. But before we move on, let's take care of one more bit of housekeeping, and that is just be aware that my presentation today is meant to help you understand the subject matter, but I am not a lawyer, so don't take anything I say as legal advice. Okay, now that we've got that out of the way, let's get going. Let's make sure that we're all starting out on the same page and define what is a wire transfer for purposes of this presentation today. The term wire transfer actually came about in the late 1800s in the United States, when the earliest form of wire transfers were made using telegraph networks, primarily Western Union. So the sender would pay money to one telegraph office, and then the operator would transmit a message and essentially send the money over the telegraph wire to another telegraph office. And they would use passwords and code books to authorize releasing the money to the recipient at that other location. So this is where the term telegraphic transfer comes from, and you don't see that very often, but occasionally you still do. Now, while the logistics have changed, the underlying principle hasn't. A wire transfer is still, in effect, a message from one bank to another to debit a sender's account and credit a receiver's account. Now, you've probably heard the term electronic funds transfer, or EFT. Well, that's a generic term that refers to the use of computer networks to transfer funds from one party to another. Besides wire transfers, EFTs include other forms of electronic payments like ACH credits and debits, direct deposit, online bill pay, money service business transfers, and person-to-person transfers like PayPal. There are also digital wallets like Venmo and Apple Pay that allow point of sale and person-to-person payments, as well as cryptocurrency. But those really fall into their own category of what's called e-money. Although our focus today is specifically on wire transfers, I want to take just a moment to clarify the main differences between wires and the other most common form of EFT, which is automated clearinghouse, or ACH. Now, we could probably spend the next 2 hours just talking about how ACH works because it's very complex with lots of different rules and technologies and settlement processes. So we'll just stick to the 30,000-foot view here. Now, one of the most fundamental differences between wires and ACH is that wire transfers are processed as ad hoc single transactions from one bank to another, whereas ACHs are processed in large batches of transactions that are compiled from smaller batches submitted to the ACH processing network by financial institutions. The next differentiator is timing. Now, there are, again, many different variables, but usually funds from a domestic wire transfer will be available to the recipient that same day, depending on the time of day it was initiated and the receiving bank's posting processes. An international wire can sometimes take up to 2 or more business days because of time zones and currency conversions, national holidays, how many banks were involved in the transfer, which we'll talk about in a few minutes, and again, the bank's posting processes. Now, in the United States, the ACH network, with a capital N, receives batches of transactions from banks all over the U.S. and processes them at preset intervals throughout the day. Most ACH transfers settle within 1 to 2 business days. The ACH network is owned and operated by the National Automated Clearinghouse Association, otherwise referred to as NACHA. Now, NACHA is a private, industry-owned, self-regulated organization, and it sets the rules for ACH payments in the U.S. And there are similar organizations in other countries. But in 2016, NACHA introduced same-day ACH payments, which has been rolled out in phases through 2021, this year. Same day in ACH speak means funds must be available to the recipient no later than 5 p.m. in the receiving bank's local time on the settlement date. For an ACH transfer to settle the same day, it has to be entered into the ACH network by a certain time in the business day. And as of just recently, March 21st of 2021, this time frame is now 4:45 p.m. Eastern and 1:45 p.m. Pacific. And the maximum single same-day ACH transaction is now $100,000, but in March of 2022, it's going to go up to $1 million. Another big difference between wires and ACH is price. Wires are relatively expensive, on average anywhere from $25 to $50 for a domestic transfer and even higher for international. Also, many banks charge a fee for you to receive a wire transfer as well. Now, ACH, on the other hand, costs literally pennies to a few dollars per transaction because of these economies of scale that come from batch processing through this centralized network. Yet another key difference between wires and ACH is that ACH transfers can be reversed for certain specific reasons, like the amount was incorrect, or the account number is incorrect, or it's an unauthorized payment, or in the case of consumer accounts, a fraudulent transaction. Wire transfers, on the other hand, are not reversible. Once a party has authorized a wire transfer and it's been sent, it's gone, and most likely the funds will be available for withdrawal that same day. Now, I won't say it's impossible to recall a wire transfer. It just depends on how cooperative the receiving bank is and whether the money's already been withdrawn. A receiving bank could, however, decide to return an incoming wire to the originating bank if they can't post it for some reason, like say the account number doesn't even exist on their system. Now, one last differentiator between wires and ACH is that an ACH transaction can be a debit or a credit. So when you're talking about ACHs, the debit or the credit refers to the impact on the receiver's bank account. So one party can initiate an ACH debit against another party's account and effectively pull funds from that account. This is what's happening when you set up automatic payments with your cell phone provider, your car insurance, and so forth. An ACH credit is a transfer of funds from the initiator to the receiver. Wire transfers, on the other hand, only go one way, in other words, sending funds to credit the receiver's account. Now, there is one type of wire transfer that does technically pull funds from the other party's account, like an ACH debit, but these are pretty rare nowadays, but you may see them from time to time. They're called a drawdown wire or a reverse wire, and they're really more of a request than an automatic process like an ACH debit would be. So there are essentially two pieces to any EFT, whether it's a wire or some other form. And these two pieces are the message and the settlement of the payment. And this concept is important to understand how different wire transfer systems work. The message is just what it sounds like. It's a set of instructions that specifies who's sending the funds to whom, through what financial institution. And there's typically some kind of extra space to include things like what the payment is for, special posting or notification instructions, and so on. The settlement is how the sending and receiving financial institutions settle up, if you will. So from a very simplistic view, let's say Bank A's customer is sending a $10,000 wire transfer to Bank B's customer. Bank A sends a message to Bank B saying, post a credit to your customer's account for $10,000 coming from our customer on this date. Now, when Bank B posts this credit, they're due $10,000 from Bank A. And how that message gets sent and how Bank A and Bank B settle up depends on the wire transfer system that they're using. So the three wire transfer systems we're going to cover today are the U.S. Federal Reserve's FedWire system, CHIPS, and SWIFT. A FedWire is operated by the U.S. Federal Reserve banks, and it's the primary United States network for wire transfers. Now, FedWire is what we call a real-time gross settlement system. What that means is that the transfer of money takes place from one bank to another in real time, and every transaction is settled on a one-to-one basis without grouping or netting with any other transaction. The volume of wire transfers processed by FedWire is pretty staggering. This is a snapshot from the FedWire website where they post their monthly statistics, and this is what was available as of early April. And these go back for a rolling 5-year period. And take a look at December of 2020. Over 18.3 million wire transfers totaling over $75 trillion, with almost 840,000 wires totaling over 3.4 trillion on average per business day. And that's a 20% increase in monthly value over November. In order to send or receive a wire transfer through FedWire, a bank must be a participant in the FedWire service, and not all banks are. So let's walk through a basic FedWire example, assuming both banks are participants. So we have Mr. Jones, who's a customer of Pinstripe Bank in New York City, and he instructs his bank, to send $5,000 to the account of his sister, Mrs. Smith, at Beachside Bank in Los Angeles. So Pinstripe enters a FedWire message for this transaction, which goes to the Federal Reserve Bank. The Fed debits Pinstripe's Federal Reserve account and credits Beachside Bank's Federal Reserve account for $5,000. At the same time, the Fed passes on the message details to Beachside Bank so they can post the transaction to Mrs. Smith's account. So what we're seeing here is a real-time gross settlement using the two banks' Fed accounts. Now, what happens when a bank that isn't a FedWire participant has a customer who needs to send a wire transfer? Well, financial institutions that don't participate in FedWire must partner with another bank that does in order to make this happen. So we typically refer to this partnership as a correspondent relationship. Let's go back to our first example, only this time assume Pinstripe Bank is not on FedWire. So Pinstripe Bank has partnered with First National Bank as their correspondent. Mr. Jones' wire transfer message will then be sent from Pinstripe Bank to First National Bank in whatever format the two institutions have worked out between them. First National then enters the message in FedWire, and the Fed debits First National's Fed account and credits Beachside Bank's Fed account. And then Beachside is notified of the incoming funds. Now, First National and Beachside are all settled up through their Fed accounts. But what about First National and Pinstripe? Pinstripe owes First National for the funds that First National transferred on Pinstripe's behalf. So how does that get settled? Well, the most common way is just through accounting entries. Pinstripe and First National both maintain ledger accounts on their books showing the receivable and or payable between them. Now, sometimes these are called just due to, due from accounts or settlement accounts or even nostro and vostro accounts. And nostro and vostro are Latin words that mean ours and yours, respectively. So this is an important concept to understand before we get into how SWIFT wire transfers work. Basically, each bank maintains either one account that's got a net running total, like in this example, or separate accounts from each bank's perspective reflecting what they owe and what's due to them. This is the nostro-vostro concept. If someone wants to send a wire transfer to one of Pinstripe Bank's customers, it will have to flow through First National's Fed account, and First National will, in effect, owe Pinstripe for that money. So both banks keep a running total of money owed to or from each of them. This is what's called a deferred net settlement process. So in this example, we see how each bank would account for the activity processed on Pinstripe's behalf. If 4 wires were processed in May, at the end of the month, First National actually owes Pinstripe $5,000, which is the net of the incoming funds they collected less the outgoing wires they sent. All right, now let's take a look at CHIPS. The Clearinghouse Interbank Payment System, commonly known as CHIPS, is the primary clearinghouse in the U.S. for large interbank transfers. It has about 50 direct participant banks, and it's essentially the private sector counterpart to FedWire. CHIPS publishes that they clear and settle an estimated 1.5 trillion in payments per day. The CHIPS is slower, but also less expensive than FedWire, which makes it more amenable to larger transactions that are okay to take longer to clear. And they say the average transfer is over 3 million. Now, CHIPS provides intraday payment finality through a real-time system. It settles small payments individually where they can be covered by the bank's available intraday balances on the system. Now, bigger payments are netted bilaterally, such as, for example, if Citibank has to pay $500 million to HSBC, and HSBC also has $500 million to pay to Citibank. So this gets settled without any actual movement of money between the two banks. Now, other payments are netted multilaterally. So let's say Citibank needs to send $500 million to HSBC, and Citibank is also expecting to get $500 million from Barclays. Now, ordinarily, without netting, Citibank would have to send $500 million to HSBC and would have a big decrease in its available cash while it waits for the money to come from Barclays. So what the CHIP system does is it puts Citibank's payment to HSBC into a queue where it waits until Barclays sends its payment to Citibank. And when this payment comes into the system, everything settles and nets, and Citibank gets the benefit of no impact to their cash position. And before the start of each business day, the banks have to fund a daily security deposit, if you will, the amount of which is recalculated every week based on each bank's volume of transactions. Now, the banks can't touch their security deposit during the day, and at the end of the day, CHIPS will use the security deposit money to settle up any remaining transactions. If a bank is in a negative position at the end of the day, they'll have to fund this within 30 minutes, and if they don't, then any remaining unsettled payments will have to be dealt with between the banks outside of CHIPS. But banks that end the day with a positive balance get all their remaining money sent to them through Fedwire. So this makes CHIPS both a customer as well as a competitor of Fedwire. And not surprisingly, the vast majority of CHIPS members are also Fedwire participants. Now, CHIPS is considered the United States' primary EFT system for international US dollar transfers. But if an international bank wants to use CHIPS, it has to have a US presence. So in effect, quote, international funds transfers via CHIPS are all really occurring within the United States. Now let's take a look at SWIFT. SWIFT stands for Society for Worldwide Interbank Financial Telecommunications. It's a sophisticated messaging system for a network of over 11,000 member financial institutions, and it processes an estimated 5 trillion in payment messages per day. Now, it's very important to understand how SWIFT differs from the other wire transfer systems. And the primary difference is that SWIFT is only a messaging system, almost like a very sophisticated email system, if you will. There is no settlement of funds like Fedwire's real-time gross settlement or CHIPS' modified real-time settlement process. Instead, the SWIFT system relies entirely on correspondent relationships that have been established by member banks. Remember those do-to, do-from accounts, or Nostro-Vostro, since that sounds way cooler? Well, that's how all payments are processed using SWIFT. Now, SWIFT uses specific message types for different activities, as the previous question kind of related to. And this messaging isn't just for payments, although that's about 70 to 80% of the volume. SWIFT messages can also be used for foreign exchange, for export letters of credit, like my bank used it for, securities trades, and much more, including just general communication between banks. Now, SWIFT is the primary global system for international funds transfers, and this makes a lot of sense because in the rest of the world outside of the US, there isn't one single central bank like the Federal Reserve Bank. Also, you're dealing with hundreds of countries and all their different currencies. Now, I haven't even touched on how different currencies work with wire transfers, and I actually don't plan to because that's a very specialized topic that's outside of our scope today. Now let's take a look at how a SWIFT transfer would work. Let's look at a simple example of a SWIFT wire transfer where both institutions are members of the SWIFT network and they have a correspondent relationship. So we have Senora Martinez in Rio, who has an account with Banco de Brazil. Now, she instructs her bank to send $2,000 US to Bonvie Winery in Bordeaux, France. Bonvie Winery's account is with BNP Paribas. Banco de Brazil and BNP Paribas have a correspondent relationship. So Banco de Brazil sends a SWIFT MT-103 message to BNP, instructing them to credit the account of Bonvie Winery for $2,000 US. Each bank makes accounting entries to record this transaction. Banco de Brazil debits Senora Martinez's account and credits BNP's correspondent account, reflecting the amount that Brazil now owes BNP for this funds transfer. BNP credits the account of Bom V Winery and debits their Banco de Brazil correspondent account, reflecting the amount due them for this transfer from Brazil. Now, as funds transfers go back and forth between these two banks, they post debits or credits to their due to/due from accounts and keep a running net total. Now, correspondent accounts are either assets, in other words, receivables, or liabilities or payables. But they do allow banks to, quote, transfer funds without ever touching cash. Now, in contrast, with FedWire, you're dealing with actual cash in the bank's Fed account. If a bank qualifies, they can actually overdraw their Fed account when outgoing wires and other debit transactions would exceed their current Fed balance at any point during the day. This is what's called intraday or daylight overdraft. And as with chips, there's often some kind of cash event at the end of the day when they make all these final settlements. Now, one interesting thing about correspondent accounts is there is some level of risk, right? Meaning, what if one bank has a large amount due from another bank and then that bank goes under? That's why when banks establish a new correspondent relationship, there's a whole lot of due diligence by both of them, including an assessment of each bank's AML program. So what happens when a bank needs to send funds to a foreign bank and the sending bank doesn't use SWIFT? Well, this is a lot like what we saw earlier when a bank doesn't use FedWire. A correspondent bank has to get involved. So let's go back to our example with Mr. Jones and his account at Pinstripe Bank. And now let's say it's Mr. Jones who's sending funds to Bom V Winery in Bordeaux. So remember, Pinstripe Bank doesn't use FedWire, so it's not surprising they aren't part of SWIFT either. But neither is Pinstripe's primary correspondent bank, First National. So what's missing is a U.S. bank that can send the payment message via SWIFT to BNP Paribas. Now, how would that bank be identified? Well, one option would be for Mr. Jones to directly ask Bom V Winery for their wire transfer instructions, including a U.S. correspondent bank. So let's say Mr. Jones does this, and Bom V's wire instructions indicate that their bank's U.S. correspondent is J.P. Morgan Chase. So Mr. Jones goes to Pinstripe Bank and submits wire transfer instructions from his account to Bom V Winery. And Pinstripe Bank submits this request to their correspondent, First National. First National then sends a FedWire message to Chase, along with the details of where the payment is ultimately going, which is to an account at BNP Paribas in France. Chase gets the FedWire message and then converts it into a SWIFT payment message and sends it to their correspondent, BNP. Now, Chase and BNP make their settlement entries, as you see here. And now, if Mr. Jones couldn't get Bom V's wire instructions, First National could decide to send their FedWire message to one of the major U.S. money center banks, like Bank of America, Citi, Chase, and Wells Fargo. And it's a pretty safe bet that all of these would have correspondent relationships with BNP Paribas, which is one of the largest French banks. So now, before we go further, let's do some clarification of the unique language of wire transfers. So there's a common terminology that's used pretty consistently across all the different funds transfer systems. And you need to know this language in order to understand the data in wire transfers. And if you're US-based, understand the requirements of the FinCEN travel rule, which we aren't going to cover in depth today, but just so you know. So we're going to stick to the most significant data elements here, but just be aware that there are more than just these. And there are many that are unique to each of the funds transfer systems. Now, some data is mandatory and lots more is optional. We're also just going to cover FedWire and SWIFT, as CHIPS uses almost identical terminology as FedWire. And also, just be aware that within the U.S. regulations themselves, especially the travel rule regulation and others that refer to funds transfers, they also use other terms instead, like transmitter instead of originator. So if you're reading the regs, you'll need to do some further translation, but it is pretty obvious. So there are the basic fields like obviously amount, effective date, transaction number, et cetera, as well as hundreds of other fields and codes that are used in the mechanics of processing the transfer. But what we're really interested in are the parties involved, how they're identified, and information about the purpose of the payments. Now, none of the systems actually refer to wire transfers as wire transfers. Instead, it's a payment message. And who is sending the money and receiving the money? Well, that's the originator, or ORG in Fedwire speak, and the ordering customer in SWIFT. The ultimate recipient of the money is the beneficiary or beneficiary customer. And then there are the banks involved. We have the originator's bank, which is the bank to whom the originator delivers the wire transfer request or payment order. The beneficiary's bank is where the ultimate beneficiary's account resides. Originators and beneficiaries are identified by their account numbers or other ID numbers in some cases, and the banks are identified by one of several types of identifying numbers. Now for Fedwire, the most common is the 9-digit Fed routing and transit number, or just Fed routing number, or Fed RTN, formerly known as the ABA number. Now, ABA stands for American Bankers Association, who came up with the idea back in the 1920s. SWIFT, on the other hand, uses what's called a Bank Identification Code, or BIC. A BIC is 8 to 11 letters and numbers that uniquely identifies a financial institution. Now, CHIPS is a little different. It uses a 6-digit code called a UID, or Universal Identifier. So let's look at Bank of America as an example. Now, many of the large banks have different Fed routing numbers for different regions of the U.S., and B of A is no exception. The Fed RTN here is what's used in my home state of Colorado. B of A also has 3 different SWIFT BICs, which are used for different types of transactions. Now, you'll notice the XXXs at the end of the codes. As I said, SWIFT BICs are 8 to 11 characters long. The extra 3 at the end can be used by a bank to identify a specific branch location. And banks that don't use this feature put those 3 X's at the end. The SWIFT system will just ignore those X's if they're present. So if you see an 8-character BIC, it just means that there's no branch code. And all of these codes are easily found in a lookup function available on each system's website, or there are third-party bank information databases that are on a subscription basis that have all of this information in one place, which is really nice. One other thing is that you may see the terms instructing bank and advisory bank used with wire transfers. Now, these are really just other names for the originator's bank and the beneficiary's bank, respectively. Now, these terms aren't used all that often in the U.S., but you may see them on transfers from other countries. Now, what if there are more than just 2 banks involved? Now, this is probably the most confusing with Fedwire transfers, so let's take a look at it first. And keep in mind that Fedwire was designed originally and primarily as a clearing and settlement system for U.S. funds transfers between 2 banks that are both Fedwire participants. And so the system still reflects that original concept today. Fedwire requires data in 2 fields called the sender DI, DI stands for Depository Institution, and the receiver DI. Now, these are, respectively, the bank that puts the payment message into Fedwire and the bank that's going to receive the message. Both must be a Fed routing number because that's the only way that Fed knows what to do with a payment message. They're going to post it as a debit to the sender DI's Fed account and a credit to the receiver DI's Fed account. Now, the receiver DI could very well be the bank where the beneficiary's account resides. And so in this case, the receiver DI and the beneficiary bank are one and the same. But what if the transfer requires a correspondent bank to get involved, either on the sending or the receiving end? And that's where we have one or more intermediary banks. The intermediary bank could be the sender DI or the receiver DI. Let's go back to our example where we had the wire transfer initiated by Mr. Jones with Pinstripe Bank, which isn't a Fedwire participant, and whose correspondent is First National Bank, to Mrs. Smith with her account at Beachside Bank. Now here are every party's roles and how they're settled. Mr. Jones is the originator, and he's identified by his account number at Pinstripe Bank. Pinstripe Bank is the originator's bank, and they're identified by their correspondent account number at First National Bank. Now, Pinstripe is the originator's bank because it's the financial institution who first received the payment order from the originator, Mr. Jones. However, Pinstripe isn't the bank entering this wire into the Fedwire system because they're not a participant. That's First National Bank. So First National is both the sender DI and the intermediary bank, and they're identified by their Fed RTN. Beachside Bank is both the receiver DI and the beneficiary's bank because they hold the account of the beneficiary, Mrs. Smith. Now, what if later on Mrs. Smith wants to send money to Mr. Jones? What would that look like? Well, Mrs. Smith is the originator in this case, identified by her account number at Beachside. Beachside is both the originator's bank and the sender DI. And this is because they're the bank to whom the payment order has been delivered, and they're the bank that will put the payment message into Fedwire because they're a participant, and they're identified by their Fed RTN. First National Bank is going to be the receiver depository institution, the receiver DI, because remember, Pinstripe Bank isn't connected to Fedwire. This also makes First National the intermediary bank, and their Fed RTN is their identifier. Pinstripe Bank is the beneficiary's bank because they hold the account of the ultimate beneficiary, Mr. Jones. And Pinstripe is identified by its account number at First National, and Mr. Jones by his account number at Pinstripe. Now let's take it a step further and take a look again at that payment from Mr. Jones to Bonevie Winery. All the information necessary to process this transaction all the way through to the beneficiary must be on the Fedwire message. So just as before, Mr. Jones is the originator. The sender DI is First National because they're putting the message into Fedwire. The receiver DI is JP Morgan Chase because they're the next one in the chain. Chase will then get that Fedwire message and convert it into a SWIFT payment message, adding all the information to the SWIFT payment message from beginning to end from the original Fedwire message. And they'll send the SWIFT message to their correspondent, BNP Paribas, who will then credit Bonevie Winery, the beneficiary. Now, we've been using this term identifier throughout these examples, and we've seen how every party to the funds transfer has its own unique identifier. Now, one important thing to know with Fedwire is that every identifier has another corresponding field called an ID type code. These are single character codes that tell you what type of number is being supplied in the ID field, whether that's the originator's ID, the beneficiary banks, or what have you. And these are all of them. So as you can see, there are lots of options. The Fedwire system is going to do some validation when certain of these codes are used. For example, if code F is used, it's going to make sure that the identifier in that field is a valid Fed routing number. Or if B is used for a SWIFT BIC, it's going to validate the format of the identifier, but not the actual identifier itself. In other words, the Fed doesn't keep track of all the SWIFT BICs out there. The numeric codes seem to be meant for originators or beneficiaries that don't have an account number at the corresponding institution. So passport number, driver's license number, etc. The most common ID type codes you'll see are F and B for the banks, and D for customer accounts. So in our example with Pinstripe Bank, if their identifier is their correspondent account number with First National, most likely First National is going to use an ID type code of 9, which is other, But technically, they could use a D if they consider their correspondent accounts to be DDAs or demand deposit accounts. But the Fed really doesn't care. So now, what does a Fed wire actually look like? Well, it's difficult to provide a standard example because most every bank uses a front-end wire transfer system to interface with FedWire, and these systems usually present the data in a nice, easy-to-read format. But if you look behind the scenes, this is what it would look like. And this is just an excerpt. So, and I apologize, this is a little blurry, but you can see the field number, its label, and the data in the field. There are certain optional fields on FedWire transfers that, if there's data there, can be of interest when you're analyzing a wire for suspicious activity. Now, not all of them are visible in this example, but the ones we can see are the originator to beneficiary information, or OBI field, and the receiver FI info field. There are also fields called reference for the beneficiary, or RFB, and bank-to-bank information, or BBI field. Now, all of these are free-form text fields. Now, in case you can't quite read this, the OBI here says, Bay T. Edwards, $34,000 US, $10,000 invoice number TT3, 2 cases Texas Tea barbecue sauce, $24,000 franchise fee for Texas Tea's secret recipe. And the receiver FI info field says, per Black Forest Bank, pay immediately, do not deduct any related fees for the transfer amount, charge fees separately. There can be some interesting information in these fields that may lead to the wire being considered suspicious. Later on, I'll give you a real-life example from my own experience of just that. Now, you'll also see 2 important numbers on every FedWire transfer. These are called the IMAD and the OMAD numbers. And these acronyms stand for Input or Output, Message Accountability Data. Each one is a compilation of the transaction date, an alphanumeric source identifier, and a sequence number. The IMAD number is assigned by the FedWire system when it receives the payment message from the sender DI. And the OMAD number is assigned by FedWire when it sends the message to the receiver DI, so input and output. And these codes are used to uniquely identify and trace any FedWire message. So while we're still on the topic of FedWire, I want to take a moment to talk about a couple of long-standing problems that FedWire can create for AML professionals. And by the way, these issues also tend to exist with chips as well. The first stems from how FedWire or chips messages display addresses of the originator, the beneficiary, and even the banks involved. And more specifically, a FedWire message displays addresses as 3 lines of text up to 35 characters each. And these 3 lines can include information in any order, concatenated, and with or without country information. So for example, an originator's address on an incoming FedWire to your bank could look like any of these examples. When just about anything in any format can go on these 3 address lines, how is your AML transaction monitoring system supposed to identify the country of origin on any of these wires? Well, not without a lot of sophisticated programming, either on the front end before the transaction gets to the AML system to try and parse out the addresses into its components. Or potentially, more of this parsing might be done within the AML system itself. Now, if your bank uses SWIFT directly without an intermediary bank for wire transfers, you've got no problem. And why is this? Well, because SWIFT adheres to an international standard for payment messages that breaks out addresses into separate fields for their individual components, of which there are 10 to account for the often complex addresses in many parts of the world. And it has a separate field for country. So your AML system can easily read that country code and then identify the payment as foreign or domestic. But a large segment Even as an example, as we saw in our poll, a large portion of financial institutions don't use SWIFT for foreign payments. Instead, they rely on U.S. money center banks and their correspondent relationships all over the world. So when that incoming foreign wire comes to the U.S. intermediary via SWIFT, it has to be converted to a FedWire message. All those address fields on the SWIFT message have to be crammed into 3 lines of text on the FedWire message. And the reverse is true for an outgoing foreign wire. The U.S. intermediary has to parse out those 3 lines of text into the individual SWIFT address fields. And how they do this, I can honestly say I don't know, but I guess they are safe in putting USA in the country field at least. So FedWire and CHIPS have finally decided to do something about this. They plan to implement the international standard, which is known as ISO 20022, for FedWire and CHIPS funds transfers. The question is when? Well, the Fed originally came out with a phased approach to implementing the standard, where phase 1 was actually set for November of 2020. And that phased approach was going to take several years and basically would have created this huge mess because some banks would have been on it and others wouldn't. So back in September of 2019, after what was basically an outcry of protest from the international payments community, the Fed announced that they were putting the implementation on hold until they could come up with a same-day shotgun start implementation plan. Now, right now, the Fed's website says that given COVID-19, it is unlikely that they'll announce any type of final decision on the ISO 20022 migration strategy before the end of 2021. So don't hold your breath. Now, I know we said we weren't going to talk about the travel rule today, but there's one more issue with FedWire that I do want to highlight, and it relates to the travel rule. So just to recap, the travel rule is a regulation that's part of the Bank Secrecy Act, which is administered and enforced by FinCEN, which is a division of the U.S. Treasury Department. And the travel rule requires that an originating bank include all of this information on its outgoing funds transfers: the full name and address of the originator's account number, the identity of the recipient bank, and of course, the amount and date of the payment. Now, the primary purpose of the travel rule is to ensure there's enough information in payment messages to help law enforcement follow the money, so to speak. Now, there are certain exceptions to the rule relating to transaction amounts and who the parties are in the transaction, and we're not going to go into those. But here's what also always amazes me. So we have FinCEN and the travel rule, and we have the Federal Reserve banks who own and operate FedWire, which are, like FinCEN, also a division of the U.S. Treasury Department. And yet FedWire does absolutely no validation that the travel rule is being followed. Literally, the only pieces of data you need to process a FedWire transfer are the sending and receiving bank's Fed routing numbers, the amount, and the effective date. That's it. It seems like law enforcement could have a lot more information at its disposal if the federal government's actual funds transfer system made that data required. Because the thing is, if an originating bank doesn't put all of the mandatory information, say the originator's name and address, on a funds transfer, then it's not the receiving bank's obligation to go back and ask for it. No, the onus is on the originating bank to comply, and the receiving bank and any intermediary banks do keep a record of exactly what they got from the previous bank in the chain. Now, this makes absolutely no sense to me, but hey, nobody's asked me yet for my opinion. So anyway, let's move on now to SWIFT. What does a SWIFT payment message look like? Well, there are lots of similarities to FedWire, just formatted and displayed in different ways. And SWIFT uses numeric codes to identify all their different fields, and the system actually does a lot of validation to make sure data is entered properly. This is an example of an MT103 customer payment message. And this is pretty much exactly what a SWIFT message would look like, although this one is totally fictitious. I've split it in half so it all fits on the slide here, but just be aware that these can often be multiple pages long. So let's take a look at this transfer. First, we have the originator or ordering customer, John Doe, with an address in Punjab, India, and his account number. The beneficiary is Flywire Payments Corporation with an address in Boston and their account number. Forex Limited is the ordering institution, also in India. The transfer is dated May 29th, 2019 for $16,530 in Canadian dollars. We already identified the originator's bank or ordering institution in SWIFT terms as Forex Limited. The institution that's putting the SWIFT message into the system is IndusInd Bank Limited in Mumbai. So they're the first intermediary bank in the chain. The receiving bank is Royal Bank of Canada, and they're the second intermediary bank in the chain because the beneficiary's bank is Citibank Canada. Also notice that the sender's correspondent is also the sender institution. Now this means that IndusInd Bank is the correspondent for Forex Limited. Also notice the details in the sender to receiver information. The two slashes represent breaks in text. It looks like we have some kind of ID number, a date of birth of November 22nd, 1994, and some other text that doesn't make much sense to us at this point. Now, there are a lot of myths and misconceptions around wire transfers, many of which are perpetrated by Hollywood movies and others through just general lack of knowledge. So here are the big ones. The first one is that you can't initiate a wire transfer and have it go through at any time of the day or night. You see this a lot in the movies where somebody breaks into the bank in the middle of the night and somehow they're able to access a computer terminal and enter a multi-million-dollar wire transfer that immediately moves the money to an offshore bank account. If this is supposedly taking place in the US, it's not going to happen if the Fed's not open. Now, a SWIFT is a different story. It's up and running 24/7 because, remember, there's no settlement involved. And there have been several successful hacks of software that's used to access the SWIFT network, which involved malware that criminals got onto a bank's computer network. And it allowed them to issue unauthorized SWIFT messages and to conceal that the messages had even been sent. And after the malware sent the SWIFT messages that stole the money, it deleted the database records of the transfers and even prevented confirmation messages from revealing the theft. Now, sometimes in the movies, there's this tense moment where someone's going to get killed or a nuclear bomb is going to go off unless the bad guy gets what he wants, say maybe $1 million. Then when he does, at the very last minute, he takes out his phone, punches in a couple of codes, and you see this little progress bar move across the screen, and suddenly $1 million is now in his offshore account. Well, this might be possible with cryptocurrency or some other dark web system, but I honestly don't know enough about that to say for sure. I just know it's not going to happen instantaneously through banks. However, back in 2019, the Fed announced their intent to expand FedWire and the National Settlement Service hours up to 24/7, 365 to, quote, facilitate liquidity management in private sector real-time gross settlement services for faster payments and to support a wide range of payment activities beyond those related to faster payments, end quote. So this new round-the-clock real-time payment and settlement service, which they're calling FedNow, kind of catchy, is expected to launch in 2023 and to be deployed in phases, of course. Now, they also say they're planning to use the ISO 20022 message format standards for FedNow payments. So the real world might just someday actually catch up with Hollywood fantasy. Now, one other common myth, in the US at least, is that any wire transfer of $10,000 or more will automatically be reported to the IRS. Now, this stems from people confusing wires with the cash transaction reporting rules. wire transfers aren't reported to the IRS just because of the dollar amount. They may be reported because they're suspicious and a SAR or a suspicious activity report is filed. But it is a common money laundering and fraud technique to wire someone just under $10,000 if the plan is for the recipient to withdraw the funds in cash. That way they avoid a cash transaction report on the back end. Okay, now let's get into the really interesting stuff, the money laundering and fraud using wire transfers. Now, wire transfers can be used as tools in all three phases of the money laundering wash cycle. So let's look at kind of a humorous hypothetical example. We have Boris Badenov, who's part of an international cyber fraud organization. And he's a master at social engineering, and he convinces his target, Bob Gullible, that Bob has won the Nigerian lottery, and all Bob has to do is pay the $9,990 in taxes on the $25 million prize in order to get the money. Now, Boris has a cohort, Sue Greedy, who's signed on to receive certain wire transfers into her personal bank account, withdraw the money in cash when it comes in, hold back 2% as her commission, and then send the rest by wire transfer somewhere else. So our lottery winner wires $9,990 to Sue Greedy. Sue gets the wired funds into her account and withdraws it all in cash. And she keeps $200 as her commission, takes the remaining $9,790 to the money services office at the grocery store, and wires it to National Products LLC, which is a shell company that Boris controls. The shell company pays a phony invoice of $8,000 for, quote, professional services to Boris's girlfriend, Natasha, and then she spends it on a used Rolex. So here we have the laundering of criminal proceeds derived from fraud, the predicate crime. Placement occurs when the funds are wired into Sue Greedy's account. Layering happens when the funds are withdrawn in cash and wired to National Products LLC and then to Natasha. Integration happens when Natasha buys a used Rolex from the local pawn shop. So why are wire transfers considered one of the money launderer's favorite tools? Well, several reasons. For one, they're irrevocable and usually same-day payments where the funds are available for withdrawal immediately. And as we saw previously with FedWire versus the travel rule, they often don't have to provide a whole lot of detail about the payment, or they can just make stuff up because it won't be validated, like Natasha's payment for professional services. The volume of wire transfers processed every day by larger banks can make it possible to fly under a bank's monitoring radar. And especially with fraud, criminals are doing fewer cross-border wire transfers just for that reason. Keeping it all within the country raises less suspicion than, say, wiring funds to the Caymans. Wires also really facilitate the layering process. Now, in our example, it was very simple, but in the real world, those funds would have bounced around to numerous entities, both legitimate businesses and shell companies with phony invoices to back up the transactions, should anybody ask, before Natasha finally got the money. Now, I'm sorry to say that the most advanced transaction monitoring systems available today are still no match for the skill and sophistication of professional money launderers. However, not everyone who launders money is that smart, and those are the ones that we can catch. The number one red flag for money laundering is out-of-pattern activity. So let's look at consumer accounts first. Most consumers don't initiate very many wire transfers because they've got plenty of other much less expensive options available to them. I mean, why pay a $35 or more for a wire transfer fee when you can send someone money through Venmo for free? So any wire transfer on a consumer account is a potential red flag, especially when the amount, the sender on an incoming wire, or the beneficiary on an outgoing wire are unusual. Now, this is often an indicator of fraud, where the account holder is a willing but potentially unknowing participant in fraud activity. Now, here are some other well-established red flags that may occur on a consumer account. Wire transfers to or from financial secrecy promoting countries like certain Caribbean nations, Panama, and Eastern European countries like Latvia and Estonia. PUPID, or pay upon proper identification wire instructions, are also a red flag. These are wires where the receiving bank is instructed to pay out the funds to a beneficiary upon their providing proof of identity. Now, the beneficiary is not usually an account holder, and these are pretty risky transactions, so nowadays many banks don't accept them, but they're still somewhat prevalent in areas with larger unbanked populations, such as migrant workers. A PUPID wire could also be cross-border, which would make it even more risky. Now, along those same lines, outgoing wire transfers requested by non-account holders are a red flag, especially if they're paid for in cash and just under $10,000. And this is a risk money service businesses face every day. In fact, even when an account holder uses cash or a bearer instrument, like a money order, to fund a wire transfer, that's also a significant red flag. Now let's talk about business or commercial accounts. Commercial accounts present a higher risk of money laundering activity in general. It's been well established that money laundering commonly involves getting proceeds from illegal activity into legitimate, respectable businesses in order to make it appear normal and legal. Now, wire transfers are much more common, though, with business accounts, especially if they're doing export or import activities, or they're more than just local. Also, businesses tend to have pretty stable patterns of receipts and disbursements. They bring in the same revenue, they pay the same vendors. Even if their business is seasonal, there's still a fairly predictable pattern over the course of a year. So when new and unusual transactions happen, that's a red flag. So pay attention to things like these. Sudden use of incoming or outgoing wire transfers when they've never really used wires before. That goes back to the fundamental out-of-pattern activity concept. And in general, frequent wire transfers with no apparent business purpose. In other words, when the nature of their business doesn't seem to justify this kind of activity, what exactly are they trying to accomplish? Patterns of incoming wire transfers followed by one or more outgoing disbursements, either by wires, checks, or cash withdrawals that add up to close to that of the incoming funds. Now, this could indicate they're acting as an intermediary in the layering phase of money laundering. Or, similar to a consumer account, this could be an indicator of a fraud situation. I have seen cases where a small business customer has fallen for a scam where they've been led to believe that they can make some easy money by receiving funds into their account and then sending the money elsewhere, and they're allowed to keep 10% for their fee. So just like Sue Greedy did. Now, this could show up as an incoming or an outgoing wire, or both in similar dollar amounts on the same day or the next day. Or there may be a series of smaller incoming wires followed by one big outgoing wire to another city or country. Foreign wire transfers are another red flag, especially if they don't do overseas business. Or if foreign wires are not unusual for that business when a new source or destination country comes up, especially if it doesn't align with their current business model. So an example of this would be a U.S. exporter who sells products primarily to Europe and then suddenly starts receiving incoming wire transfers from Cambodia. Red flags like this do warrant a bit of gentle inquiry with the customer to find out what's going on. And if their explanation seems reasonable, then watch for a while to see if a corroborating pattern develops. And also look for external information that could validate their explanation. For instance, if this customer told you they're getting into a new product line that they're selling in Southeast Asia, that would explain some wires from Cambodia. Now, the company's website or related industry sites may have press releases or other information that corroborates what they're telling you. And along those lines, a customer's explanation for an unusual transaction that doesn't make sense or doesn't seem to have a valid business purpose is a big red flag. And here's a real life example of that. I had a business customer who did a lot of foreign exports of fruits and vegetables, so they routinely received incoming wire transfers from all over the world. Now, one time, they received a $50,000 even wire transfer from a company in the UK. However, the bank that sent the wire was in Latvia, and the explanation in the wire transfer's originator to beneficiary information, or OBI field, was, quote, payment of Sony home theater system, model number something, something, something. And a few days later, they received another identical incoming wire transfer with the same instructions. So we actually looked up the Sony model number and found it was real, but it was only sold in the UK, and it cost about $1,200 in US dollars, certainly not $50,000 or $100,000. So we had this customer's relationship manager reach out to them with a copy of these wire instructions, asking about the business purpose of the transfers. And their response, which was in writing, and again I quote, was, "These are payments from a buyer in Vietnam who pays on account." Okay, right. Well, the story goes on with this customer continuing to receive more bizarre incoming wires from what we identified as shell companies in a number of countries, including Panama, St. Kitts and Nevis, and New Zealand, all coming through banks in Latvia with other strange explanations like for computers, or one even said for clothing. Another red flag is when there's a high volume of wire transfers on an account, but the account balance is always low. Now, this can be a red flag for something called a funnel account. A funnel account is where illegal cash is deposited by many different people at different branches of one bank in one part of the country, and then someone else immediately withdraws the funds in bulk at another branch of the same bank on the other side of the country. Large wire transfers by a cash-based business are another red flag. As we know, cash-based businesses in general are a higher risk for money laundering, and when they're depositing large amounts of cash and then wiring funds someplace else, there should be some further inquiry. Another one that I've seen a lot over the years is incoming round amount wire transfers of $25,000 to just under $50,000. Now, these amounts seem to be some kind of magic number when it comes to fraud and money laundering, and maybe they think these amounts are less likely to be detected by a bank's monitoring system. I don't know for sure, but common sense would say that $1 million wire would probably generate more scrutiny than a $25,000 wire. Now, it is important to remember that all of these are red flags only. In other words, patterns and behaviors that should trigger more investigation to determine if they seem to be legitimate or if there's something that merits a suspicious activity report. Now let's switch over to wire transfers and fraud. Fraudsters like wire transfers for all the same reasons that money launderers do. And as well, fraud is a predicate crime for money laundering, so they tend to overlap. In my former role, I oversaw both the anti-money laundering and the anti-fraud groups. We leveraged the systems and the knowledge from both of these groups to be more effective overall. This concept, meaning the convergence of fraud and anti-money laundering, has become known by the acronym FRAML. Now, this was originally coined by the fintech company Verifin, and it makes a lot of sense. I used to give a simple explanation to people who would ask me, what's the difference between fraud and money laundering? And my explanation was that fraud is something that happens to our customer. In other words, they're the victim. And money laundering is something we believe our customer may be doing that's illegal. Now, my bank serves primarily commercial clients through large revolving lines of credit. Our customers moved money on and off their accounts primarily by wire transfer and secondarily by ACH or checks. Now, our fraud monitoring system was a real-time interdiction system that would stop a suspicious wire or ACH batch from going out of the bank until we could confirm it with the customer. Now, many times, suspicious transactions that have been stopped by the fraud monitoring system would subsequently be validated by the customer and then released. Our fraud analysts, though, through our Framel approach, were also trained to recognize the red flags for money laundering. A transaction that was flagged as possible fraud but confirmed as valid by the customer could also be a red flag for money laundering by that customer. So our fraud analysts would pass on the details of these transactions to our AML team. And many times our AML monitoring system, which was not real time, would subsequently flag that same transaction. So there are lots of synergies to be gained from having your fraud and AML groups work closely together. But let's get back to wires and fraud specifically. A 2013 white paper that was published by the ABA quoted research that found 76% of all fraud attempts involve wire transfers. And it's probably safe to say that figure is the same or even higher today. The reason for that is wire transfers not only offer more opportunities for fraudsters because of technology advances, but also because of the many different methods of compromise, points of compromise, and ways to initiate a wire. Methods of compromise include malware that gets onto a customer's computer or even a mobile device. Social engineering, where the fraudster convinces someone to send funds by wire. Then there's phishing, vishing, and smishing to fool someone into providing personal information, like account numbers and passwords, and the widely successful email compromise scams. Oftentimes, it's a combination of these. For instance, phishing could result in an email compromise, which could then be used in a social engineering scam. We see the different points of compromise could be the customer's computer or mobile device, allowing the fraudster access to online or mobile banking systems. Or it could be the bank's call center, where the fraudster initiates a wire transfer by impersonating the customer, using personal information like a password, a PIN number, mother's maiden name, and so forth, obtained through one or more of the methods of compromise. And in the same way, another bank employee, such as a relationship manager, could be fooled into believing they're dealing with a customer and provide transaction authorization. And then we have all the different ways to initiate a wire at a branch, by email, through a mobile or online banking system, or through a call center, by fax, or through another bank employee like a relationship manager. I mentioned social engineering. Social engineering is probably the most prevalent and most successful type of fraud that primarily uses wire transfers. Simply put, it's manipulating a person into doing something that they ordinarily wouldn't do. It preys on human nature, such as our desire to do a good job or be responsible, be a good employee, or human emotions like fear, loneliness, or pity, or just good old basic greed. The biggest trend in social engineering over the years has been what's called business email compromise. What makes this and social engineering in general so successful? Well, it's because it's not technology focused. Instead of computer systems, fraudsters are targeting people. And these frauds are based on the idea that employees they target aren't likely to question an email that comes from what appears to be their boss's boss, or even their boss's boss's boss, or to double check and verify information when they're being told to rush or to maintain secrecy. Now, this fraud technique is not about targeting vulnerabilities in networks or security. It's about targeting people, and people make mistakes. The medium-sized businesses are a very popular target for social engineering because they're likely to have more money than a small business, but yet they may not have the comprehensive internal controls that a large company would. But even big companies fall for these scams. Take a look at this list of the largest known business email compromise and CEO impersonation scams. 100 million lost by Facebook and Google on payments of fake invoices. 75 million Crelon Bank in Belgium. 31 million Zoom Corporation, which is an electronic funds transfer provider, no less. They're owned by PayPal now. This was an employee impersonation scam. 18 million by Tecnimont SPA, which was an Italian engineering company. This was a CEO impersonation involving a fake company acquisition in China. 17 million, the Schooler Company, a U.S. commodities trading firm, exact same scam as Tecnimont. And I had a customer who nearly lost $600,000 to this exact same scam. When I read about these other attempts later, I could not believe how they were identical to the one that targeted our customer. And I say nearly lost because of what was basically a miracle. Our customer's controller had entered a $600,000 wire to China in our online banking system, and our fraud system flagged it. We called her, and despite our best efforts to get her to hold off until she could confirm this payment with somebody else, she insisted that we release it, so we did. Later that night, she had some misgivings, and she actually phoned the CEO of her company, who she thought was instructing her to send this money to China for a secret company acquisition. And of course, he told her that he had no idea what she was talking about. And then, of course, she was on the phone to us at 6 a.m. the next day, begging us to get the money back. Well, we tried because we thought maybe it hadn't been processed yet by the U.S. correspondent bank. We don't do foreign payments through SWIFT, just through U.S. correspondent. So we tried to get the U.S. correspondent then to ask the Chinese bank to return the money, but the correspondent wasn't willing to do that for us. Again, another example of the finality of wires. Then 2 days later, a miracle happened. The funds came back to us from the Chinese bank. The reason they stated on the wire that they were returning it was that the name on the account that was to be credited did not match with the beneficiary's name on the wire. So the fraudsters gave the controller either the wrong beneficiary name or the wrong account number. So like I said before, they're not all that smart. Now, many red flags for fraudulent wire transfers are the same as those for money laundering, just from a different perspective. And also with fraud, it could be the way the wire transfer is requested that's the red flag. So out-of-pattern activity is always the number one red flag with sudden use of wire transfers in particular. Incoming or outgoing foreign wire transfers, especially from a consumer account. Incoming wire transfers of just under $10,000, followed by a cash withdrawal of a similar amount. Also, outgoing written wire transfer requests in a non-standard format. For example, if the bank has a standard form for wire requests and a request instead comes as a typed letter that was sent by fax or by email. Now, here are some of the recommended best practices for financial institutions to mitigate wire fraud. On business accounts, require two-party authentication on any free form, in other words, not based on a template, wire transfer, and then whenever a customer creates a new wire transfer template, there should be a secondary approval of that. Also, you should confirm by phone to the customer's primary telephone number on file on a recorded line any wire transfer request received through fax or email. It is a very common fraud technique for a fraudster's email wire request to say, oh, I'm currently out of town, and sick relatives or funerals are commonly mentioned, and I can't be reached at my usual contact number, but yet they somehow were miraculously able to contact you in some other way. But anyway, better yet, don't even accept fax or email wire requests, either in person or through online banking or a call center with verification. Educate customer service and fraud interdiction staff on how to handle a customer who is likely being scammed. Explain how the bank has seen similar situations. You want to protect them. Do they know this person? Have they spoken directly to the one authorizing an outgoing payment, etc.? And we would also tell a customer that we'd hold an outgoing wire until they could contact the requester by phone or do some other kind of verification. Just that alone probably saved our customers millions of dollars. Now, outgoing frequent customer education, ongoing frequent customer education, I should say, is critical too, especially for business customers, because they're the ones who think this couldn't possibly happen to them. But unfortunately, for most businesses, it's not a matter of if it will happen, but when. Just some final thoughts here now as we wrap up. The methods for moving money from one party to another are continuously and rapidly evolving. Faster and faster transactions with a minimum of information about the parties seems to be the primary driver of this growth. However, in my opinion, these developments only make it easier for money launderers and fraudsters to get away with what they do. The regulations just can't keep up with the speed of change that we're seeing in the alternative payments industry. Also, Nacha, the ACH network provider, seems intent on replacing wire transfers altogether, with increasing same-day payment availability and larger same-day payment limits. Now, some say wire transfers as we know them may soon be a thing of the past. However, despite even these advances in ACH and alternative payments, I still think wires will remain. The infrastructure that's been established for wire transfers is so deeply embedded in global banking and finance that it may take decades to change significantly, even if ever. So make sure you understand the mechanics of wire transfers and all the other types of funds transfers your institution processes so that you can better recognize how wires can be used in money laundering and fraud. Recognize as well that out-of-pattern transaction activity is the #1 red flag for money laundering or fraud activity. And when it involves wire transfers, it's actually easier to spot and research than other types of funds movement. If you've ever had to find one transaction in a huge ACH batch, you probably know what I mean. And lastly, consider the synergies that you can gain from merging your AML and fraud groups. 3/4 or more of all frauds involve wires, and fraud, especially cyber fraud, is a huge source of illegal proceeds to be laundered. At a minimum, you should train your AML staff about fraud and your fraud staff about money laundering red flags and find a way for them to communicate. Well, thank you so much for participating in today's webinar, and I hope you got some good takeaways from it.
With that, I'd like to thank Laurie for today's presentation and going through people's questions, and helping us understand more how the system works and, what are some of the risks that you need to be on the lookout and some strategies to deal with these risks. Thank you to Nicole in the background who's moderating and taking everybody's questions and passing them along. And thank you to the audience for spending the time with us. We hope you found the presentation useful. And with that, I'd like to close the presentation.